Good afternoon, Samson family. I'm Aladdin Katheri, commercial director here at Samson Properties. And this is a continuation of the first unit of commercial real estate investment analysis. Now, last week was a very long introduction to real estate economics. And when I introduced real estate space and asset markets, and I covered the space market portion of that. So today we're going to talk about asset markets. So the four areas that I want us to focus on are capital markets. I want to talk about real estate as an asset class within the context of the overall market for capital, right, or money. And introduction to pricing, and how the asset market is not segmented like I said the space market is. And I'm estimating the time to be no more than an hour. There, now everybody's watching the clock. Okay, so let's get started. The space market is the most fundamental type of market, as we talked about last week, as it relates to the real estate business. The asset market, though, is equally important. The real estate asset market is the market for ownership of real estate assets. And we know that real estate assets consist of real property, meaning land and the land parcels and the buildings on the land. And that's the perspective I'm going to be talking about them for the most part. From an economic perspective, these real estate assets consist mostly of claims to future cash flows. Specifically, the rents the buildings can generate for their owners. These assets can be compared to and actually compete for investment money against other forms of capital assets like stocks and bonds. I almost said crypto, but I'm not even sure if that might be, right? That's an investment choice. The net rents generated by a building are comparable to the dividends paid by stocks or the interest paid by bonds. So real estate or property competes for investors' capital against these other forms of investments. And therefore, we should view the real estate asset market as part of the whole market for capital assets of all types. Let's go a little deeper. Broadly speaking, the capital markets can be divided into four categories according to whether they are public or private, and according to whether the assets traded are equity or debt. Public markets are those in which small identical units or shares of ownership and assets trade in public exchanges with many buyers and sellers and, who are trading simultaneously. So they're all participating in the market with current price quotes available for everyone to see. Instant price quotes, right? The stock market is a public capital market. In these public capital markets, transaction prices at which the units of the assets, the underlying assets, trade are typically reported publicly and instantly. And that's relatively new. It didn't used to be like that. Remember, we used to read the stock page in the newspaper from yesterday's stock, but now it's instant, right? Public markets are characterized by a relatively high degree of liquidity, in that it's possible to quickly sell units of the asset at or near the last quoted price. And this liquidity is both a cause and an effect of the fact that in public markets, asset share prices can adjust fast to relevant news about their value. And this ability of asset prices to respond quickly to relevant news is known as asset market informational efficiency. Private markets, on the other hand, are those in which assets are traded in private transactions, arranged between individual buyers and sellers who somehow found each other through some sort of search process, often through the aid of a broker. It's common in private markets, though not necessary, for whole assets to be traded in a single transaction. Again, compared to stock market, you're buying a share of a company. You're not buying the whole company. So the entire company or the entire parcel, right? Or financial instrument, the entire mortgage. And this means that the governance or the control of the operation of the underlying physical asset is traded along with the ownership and the financial claims that come with that ownership. Not financial claims against it, the financial claims, the reason why that investor is buying it. And the average size of individual transactions tend to be larger in the private market than in public capital markets. Private markets usually are, of course, less liquid than public markets. It takes time for sellers to find buyers, right? We're all in real estate. We understand that, right? And price discovery is more difficult for a given whole asset. Transaction costs are higher in private asset markets, and because of that, transaction costs and search costs, well, that's the reason why they're higher, right? Privately traded assets are traded less frequently also than publicly traded assets. The fact that whole assets are traded in private deals between one buyer and one seller, instead of many buyers and sellers at the same time trading shares, also has consequences for the nature of the asset price information that's available to the public. In private asset markets, it's harder to observe the prices at which assets are trading until after the transaction closes, right? You guys follow me, right? You get that? And sometimes longer than that. And sometimes price information is not available at all. Also, as whole assets are unique, right? Real estate is unique. It's more difficult to know how relevant an actual transaction price is for judging the value of any other asset, right? You guys got comps in your head, right? I hope so. The problem is compounded by the fact that the parties to each trade are also unique, right? So the actual price or the observed price represents only the agreement between the two individuals, not a broad market consensus. You and I are in a transaction. I'm the buyer, you're the seller, and we come to a price. But that doesn't mean the whole market says that's the price, right? The same assets are not repeatedly sold very frequently, which even makes the trend in prices over time difficult to observe. So, asset values in private markets tend not to incorporate or reflect news and information as quickly as do prices in public asset markets. Private asset markets tend not to be as informationally efficient as public markets. So again, price discovery process is much slower. For example, suppose you own an apartment building in Arlington, and you think the property's worth about $10 million, but you're not sure. And then you hear some news about something that you think might negatively affect the value of your property, like rent control, right? So you expect that this reduces the value of your property, other things being equal, at least below that $10 million valuation that you had. But by how much? Does it reduce it to a $9.9 million or $9 million? Or where? Now, if another property near yours, similar to yours, would sell, and you could observe the transaction price, this might give you some idea about how the value of your property has changed, some idea. But it wouldn't give you a definitive picture. The other property is not just like yours. And the buyer or the seller in that deal may be different in some way from you, or may not have negotiated the way that you would have. And there may not be another similar property nearby that sells anytime soon. So you don't know how much to mark down your appraised value, or your appraised value. I don't mean like an appraiser did it, but your appraised value of the property as a result of this recent rent control news. So compare this situation to that of publicly traded assets. Suppose ownership of your apartment complex, same building, was divided into thousands of small, homogeneous shares that were constantly being traded by many buyers and sellers, right, at publicly quoted prices on the stock exchange. Now, in this situation, you would know immediately, with certainty, more certainty at least, the effect of the announcement of rent control on the value of your shares, just by observing the change in the share price. Another way to think about it, on the other hand, sometimes the public market overreacts to news, right? So when that happens, there has to come a correction to price later, sooner or later. And this, because that happens, this causes excess volatility, right? Sometimes the stock market can be subject to fads or herd behavior, right? That can move the market in a big way, in a direction that may not be related to anything real. The point to take away from this is how fast public or private markets respond to news doesn't guarantee that asset prices will behave better in one market form or another market form, private market or public market, in terms of how the individual investors make investment decisions. So let me go back to this slide. Excuse me. Let's look at a comparison of the columns to a comparison of the rows to consider debt versus equity. So debt and equity are two different types of capital assets. Both can be traded in either public or private asset markets. Debt assets are the right to future cash flows to be paid out by the borrowers on loans that they've taken out. The characteristic feature of debt assets is that they give their owners a senior preferred claim for obtaining the cash that the underlying asset, the building, or that source of the cash flow can generate. Also, debt cash flows are contractually specific. The recipient knows more precisely and with a high level of certainty how much future cash flow they'll be receiving and when. That makes debt assets less risky than equity assets. Debt assets also have a very specific maturity, right? A set lifetime after which there's no more cash flow. For instance, a bond may pay 8% of its face value in interest each year for 10 years and then be retired by paying that face value or stated value. And that's it. Equity assets, on the other hand, are those that give their owners the residual claim on the cash flows generated by the underlying asset, the property. So residual claim, whatever's left, right? That's the equity assets. The residual claim is subordinated to any debt owed on the underlying asset. So it doesn't have any seniority and it doesn't have any priority. Because equity claims are what's left after senior claims, equity tends to be more risky than debt. I'm going to talk about risk a lot, probably a lot later. But the equity owners have more control. They control the property, right? They control managing the asset, and they're better able to benefit from growth or any upside potential in the cash flows generated by the asset. The debt, if the property value increases by a certain amount or the cash flows increase, the debt payment is the debt payment, right? Your mortgage payment is still your mortgage payment. That doesn't change. So equity assets, like stock and real property, are typically infinitely lived. Now, infinite life, what I mean by that is the owner of an equity asset has to sell that asset in order to cash out or liquidate their holdings, right? It also means that more of the present value of the asset derives from the expected cash flows in the distant future, where there's the most uncertainty or more risk, right? If you don't know, it's risky. Another reason that the value of equity assets tends to be more volatile than the value of debt assets. Capital asset products based on real estate have been developed for and are traded in all four of these branches of the capital markets. REITs, right? Real estate investment trusts. They offer publicly traded common stock shares in companies that don't do much more than own and manage or buy and sell income producing properties or mortgages. Mortgage-backed securities include publicly traded bonds, bond-like products that are based on underlying pools of mortgages. And these are real estate-based debt products. There are residential mortgage-backed securities and commercial mortgage-backed securities. And there are many mortgages, a lot of them large commercial mortgages, that are held privately as whole loans. And when I say privately, I usually mean by the bank, and would be traded privately if they're traded at all. But the most fundamental form of real estate asset is direct ownership of whole properties, the building, right? And those are traded in private markets where individual real properties, from single-family homes to income-producing commercial and residential, meaning apartments or industrial buildings, or land parcels, right, or other assets. They're bought and sold between parties who have found each other through the services of, often, us, real estate brokers. Ultimately, all the other forms of real estate-based capital asset products are based on privately traded property as the underlying assets. So property assets produce the cash flows, which is the source of any income or value for any real estate investment product or vehicle, including REITs and mortgages. So that's the owner side. The demand side of the property is made up of investors who want to buy property, right? The supply side consists of investors or developers or owner users who want to sell some or all of the property they own. There are two main investors in the property market. This is our customer base, right? They're individuals or smaller firms, right? Individuals and smaller firms. I'm going to group that into one. And then larger financial institutions. The major institutions include REITs, pension funds, life insurance companies, and other types of funds, banks, other financial institutions. We're not likely to encounter those if we're out here brokering commercial real estate. Okay? That's kind of, I'll use the term, way above our pay grade. That doesn't mean that you can't. If you happen to be able to get a deal like that, wow, congratulations. Private individuals, that's our target, right? Invest in the property market both directly, whether it be through partnership or corporation, formed between a few parties, and through funds or syndications. And many investors in the U.S. real estate market are foreign individuals or foreign institutions. So those are the players. So one can say, we should say or think, that our capital markets here in the U.S. are highly integrated, right, which is the opposite of, what was the word I used last week? I forgot. I'll say it again. They're highly integrated and sophisticated, all right? The markets are well-functioning, and I'm talking about the capital market, the market for the money, right? Where's the money going to go? Where huge quantities of money and information are managed and exchanged. The capital markets determine how the wealth and the capital resources of the society, in this case, this country, are allocated, which in turn determine the future growth rate and economic production patterns in the economy. If investors decide that the future earning potential of semiconductor companies, right, that's a big thing in the news right now, look relatively good, while office buildings look relatively bad, then semiconductor company stocks will rise, right? And the capital or the money will flow to that industry, while office building prices will fall, right? And developers are going to struggle to find money or the funds necessary to build new office buildings. This is how capital markets govern the physical allocation of the productive resources of the economy, primarily where the money goes. So because real estate makes up a large and important part of capital markets and the physical capital formation of our economy, the real estate component of capital markets is important in this overall allocation process. In fact, the value of all real estate assets is comparable to, and sometimes greater than, that of the entire stock market of the United States. Let's take a short break. I need some water. Didn't I say I was going to say that? Any questions, by the way? Any questions? We good? All right, let's go to this next slide. This graph, and let me talk about some of this data. So I got these pie charts here I'm going to show you. And the data, you see that it says 2014, right? I mentioned earlier about the collection of data is slow. Now, if you subscribe to some of these data providers, like CoStar, they provide information, or others, I try not to say brands because I don't want to lean toward a certain one. There are data providers out there. You can get this data, right? But I didn't do that for the purpose of this, what we're talking about. So I'm using old data, all right? But what's remarkable about it is when we say some of these numbers and think about right now, it's like, wow, they've changed. So let's look at the extent of real estate assets in capital markets. These next two slides are going to give an idea of the degree of real estate assets in capital markets in the U.S. in the early 2000s. This one illustrates the proportion of the total market value of all U.S. assets in each of the four sectors, right? Public, private, debt, and equity. And the percentage you see on there of each of the sectors that's represented by real estate assets. And you see here that real estate is dominant in the private capital markets, right? This slide presents a more detailed breakdown of capital assets by category of assets. So you can see that more than 2/3 of the value, it's like from 3 o'clock to about 8 o'clock, right? If that was a clock. 2/3 of the value, more than 2/3 of the value of the investable capital assets in the United States was in real estate, right? Early 2000s. Now these numbers certainly have changed, right? I mean, as far as if we did a pie chart from today or the last 5 years, they're hugely different, right? It's still more than 1/3, more than 2/3 assets are in real estate, but how they break down are different. So again, the numbers changed since then. I don't have current data to share. That's not important to illustrate the point. And so you can see here that the largest value categories in real estate include single-family housing equity, which, and I think we're at 2014 here, was over $10 trillion in value. Commercial real estate equity, all of it, was just over $5 trillion in value during this time, which includes little more than about $300 billion of that was held by REITs, right? And another 2 to 3 trillion was corporate real estate held by publicly traded non-real estate firms. And those are tracked, or those are categorized as part of the value of the stock market. So when you're looking for the data, right, if it's owned by a corporation that's publicly traded, you're going to see that in stock market data. It's not going to show up, or it's hard to find in real estate data. Residential mortgage account, we talked about, that was equity, right? So that's what piece of that property is your equity. Residential mortgages account for over 10 trillion, about half of which is included in publicly traded mortgage-backed security products. Question?
Can you qualify, are you talking about this chart or the previous chart? Because this chart I see more.
Yeah, I'm talking about this chart. Let me get it close.
So where do you see?
So, okay, I can look at it here. Let me kind of go through this with you real quick.
I see the 2/3 being stock and bonds. I don't see it in, maybe I'm not looking at it right.
All right. So the real estate is, look at, like, if this was a clock, look at like 4 o'clock, right? It says REITs, right? And all the way over to that last one, private commercial mortgages, 3%. And they have these percentages. Those are real estate. The top blue one, that's stocks. There's no real estate in that.
Correct.
Right? Unless it's owned by, if real estate is owned by a corporation that's publicly traded, that numbers, we're not seeing the real estate broken off.
Right.
Okay? And private debt, right?
I still don't see 2/3 of it being real estate. I see maybe.
Gotcha.
Maybe,
okay. Did I say 2/3? I think I meant to say 1/3.
Yeah.
Real estate. Yeah, I think I meant to say 1/3, because that's not 2/3. You're right. Thanks.
Yeah. Just
Thanks for the correction.
thank you.
Can I continue? All right. So, yeah, so about 1/3 of that value was in the form of single-family home. Okay, wait, that's where I got my numbers mixed up. So now we're looking at the real estate portion, that bottom part. 2/3 of that was in the form of single-family homes. Make more sense? Okay. And the rest, mostly commercial or income generating and institutional property. At the same time, to compare, the approximate stock market value, early 2000s, was approximately 17 trillion. So during this period, real estate value was more than the stock market. So again, I don't know our current numbers, but I know our stock market's been doing great, right? I don't know what the valuation is. It's an easy Google. I didn't do it. So you guys can Google that and compare. All right. A side note, this slide is about equity, right? So a $100,000, I want to show you where the numbers came from. So a $100,000 house with an $80,000 mortgage would be counted as $20,000 of housing equity in the private equity segment, and $80,000 of residential mortgages, that would be public debt. Okay? So that's that breakdown of where the numbers came from. If the mortgage was part of a mortgage-backed securities pool, it would be public debt. And private debt, if the mortgage was still held by the bank. So to get another perspective on the magnitude of commercial property in the U.S., this data came from CoStar, to show, mostly CoStar, to show U.S. commercial property by physical stock, right? This is going to be the one on the left, in billions of rentable square feet. Now, what's not in here, it excludes specialty or entertainment type properties. Why? Because CoStar didn't have data for that. That's the only reason, that's not included. And the picture on the right shows the same property categories by total dollar value of market cap, counting about 84 billion square feet of commercial property with a total market valuation of $9 trillion. These depict the major categories as described in this, by the way, this study, this 2010 study from CoStar. So this was 2010. For those who don't know CoStar, I mentioned it, they're a commercial real estate information firm. They sell information, okay? The property inventory, I said that because someone asked me, well, what's CoStar do? I was trying to think, what's a really swift answer for that? I think they sell information. Good answer, right? The property inventory in these pie charts include all income-producing property in the United States. And for apartments, I only included 5+ units, right? Properties with 5+ units. Properties with 1 or 2 or 3 or 4, they were not included, right? Because that's residential, okay? The pie charts include the larger, it includes everything. The larger, more expensive properties in major metro areas that are typically actively traded by national and international institutional investors, and the smaller and less expensive properties that are mostly traded by private investors, owner users, owner occupiers, mom and pops, us, regular folks, right? But overall, the largest category by physical size are industrial, again, based on the state 2010. The largest by physical size are industrial and multifamily properties, while the greatest by value were retail and multifamily properties. Again, a lot has changed in the last decade, right? Because these numbers have changed. The greatest values, I think, right now are in, well, I think multifamily is still in there. And actually retail. Retail is still higher value than industrial. The average value per square foot in 2010 was $109 a square foot. The most value-intensive categories included healthcare facilities at $490 a square foot, office and retail properties at a little bit more than $100 a square foot. The least value-intensive categories were industrial, warehouses, rental, industrial space at $45 a square foot, and apartments at $62 a square foot. Another thing to note, at least during this period, hospitals, office, and retail properties tended to be found more in the central and the most valuable locations in terms of value per acre of land, while industrial properties and apartments were often not centrally located. Again, the trends have changed. So how do we price all this? How should we price commercial real estate assets? In other words, how do real estate assets get their values in the market? So remember, the supply side of the property market are owners wanting to sell or reduce their holdings of real estate assets. And the demand side of other investors who want to buy or increase their holdings, right? The balance between the supply side and the demand side actually determine the overall level of real estate asset values, obviously, right? Relative to other forms of physical and financial capital in the country. So within this valuation context, specific values of individual properties or buildings are determined by the perceptions of potential investors regarding the level and riskiness of the cash flows that each individual property can generate in the future. So real estate being unique, properties and buildings come in different sizes, different magnitudes, and different locations. When thinking about property prices and values, think in terms of property value per dollar of current net rent, right? Or current net income. This way, you can easily compare prices across properties of different sizes or values. In commercial property markets, a measure that is the inverse of this price to earning multiple is most widely used to describe prices and values. And this ratio I introduced last week, a lot of you know about it. It's the cap rate, capitalization rate. So the cap rate is simply the property's operating earnings, or the income, net income, divided by the property's asset price or value, as if there were no mortgage. right? Take the mortgage out. It's just income divided by price or value. And we can compare cap rate to current yield, which is the amount of current income that an investor receives per dollar of current value of the investment. So when you look at the stock market, current yields, right? The cap rate is an inverse measure of asset value per dollar of earnings, right? You can think of it as a direct measure of the current income component of the return on the investment. So property values can be represented as earnings, such as net rent divided by cap rate, right? Price equals net, or earnings equals net rent divided by cap rate. And that's just a convention. That's just the way we do it. It's not a statement of causality. It doesn't suggest, cap rate doesn't suggest that property values are caused by the current income generated by the property and the current cap rate prevailing in the asset market for similar properties. Right? It doesn't cause it. It's just a measure of it. Anyway, investors are more interested in total return, which is the income and the capital appreciation, than they are in just current income alone. Because we do cap rate, we do either the trailing 12 months or the forward 12 months, but it's current. Investors should take a long run view of the potential and risks in the property's future income and value, not just current income. So investors are, no, I need this cap. You get to why. Why are they're not buying a property because of a cap rate, right? The expression of cap rate is talking about how much I'm going to pay for it, right? The cap rate is actually determined by capital investment, supply and demand in the asset market, and is based on three factors. The first one, the opportunity cost of capital. The prevailing interest rate or opportunities for earning returns in other forms of investment in the capital market, such as stocks or bonds and other money market instruments. Let me say this a simple way. Where else can I put my money and make more? What other opportunities do I have, right? So if I'm investing here, I'm not investing there. That's opportunity cost. And these are major determinants of how much investors are willing to pay, right, for any property per dollar of its current income. Real estate assets are in competition for the investor's dollar, with capital competing with other properties as well as other forms of assets. So when interest rates and yields on bonds and stocks are low, investors won't earn as much return for those types of alternative investments. So they'll tend to be more eager to put their money in real estate. Like now, right? Bonds, right? The returns are low. Not on stocks. So investors will put their money in real estate and they won't expect to earn as high a return from a property as they otherwise would from these other types. So this raises the price they're willing to pay for the property per dollar of its current income. And what's that do? It reduces the cap rate. The second factor is growth expectations. So investors are forward-looking. They estimate the amount of growth or decline in the net rent that they can expect the property to generate in the future, right? Are my rents increasing? Are they decreasing, right? Or are they increasing in relation to inflation rate, right? Real rate rents. And the net rent in the future depends on what the balance between supply and demand will be in the future in the space market. So really, to consider the growth question, investors try to forecast the future of the space market where the property is situated. Right now, there's a lot of conversation you hear a lot of voices talking about the future of office. They're trying to figure it out. They're trying to predict it, right? The greater the expected growth in future net rent, the more investors are willing to pay for the property today per dollar of current net rent. And again, meaning smaller cap rates. For example, if investors were willing to pay $15 instead of $12.50 per dollar of current net income, then the cap rate would be 6.67 instead of 8. You see that? So $15 or is 1 divided by the $15, so it's per dollar of net income, right? There's your cap rates. This doesn't imply that investors are willing to settle for a lower return. It means that more of that return is expected to come in the form of future increases in earnings or in appreciation or capital growth in the future value of the property, and less so in the form of initial income. Let me jump to this real quick. So a lot investors are looking at, and investors have different strategies, right? Some will buy a property and they're buying it, and what's most important to them is the increase in value. I'm going to hold it for 5 years and it's going to be worth this. Some investors, so that value is a combination of what it's worth in 5 years and the cash flows that between when I bought it and. So often you want to look at how that breaks down. Where's my value coming from, right? Some investors focus on the cash flow, right? So their strategy is, let me increase these rents, right? And then maybe they don't care about the sale price when they sell it, right? Not that they don't care, but it's not as important. Make sense? So, okay, growth prospects. Growth prospects for rent in the market depend on the state of the market, right? Are current rents below the long-run equilibrium level? We talked about that last week. How will usage demand change in the future, right? More people going to use office, less people? Are they going to lease the same amount, smaller spaces? What are companies doing? Is the shape of the long-run supply function, remember that kinked one? Is it flat? Is it rising? Is it declining? Each individual property may have unique attributes that affect its own growth prospects, in addition to market considerations such as existing leases or the need for capital improvements. Remember this is about price. So it's not about the comps. It's not. I mean, you can look at the comps and look at price. These sold for 4 caps, these sold for 5 caps. But it's about what's going on in that property. I as an investor may need 15% return, but I'm going to hold it for 10 years, right? Someone else may need a different return, and their hold period may be different, right? You can't price a property, especially for a buyer, if you don't know what they're going to do with it. You can't price it. You can give them a number, but you just made it up, right? You have to know what they're going to do with it, because then you can talk about how they're going to make money. If rent increases, and sometimes it takes a spreadsheet. Well, when are your rent increases? Every 5 years. You put them in. Put them in. You know, Excel, I love it. You can just put the formula in. Boom. And then you can see, if you hold this for 5 years, you make this. If you hold it for 10 years, you make this. You need to sell it. Whatever those things are. But you can't have that conversation if you don't know what their goals are with that property. I just want to buy something commercial. You're not doing anything. They're not going to do anything. Because if that's where they are, they're going to figure it out. And as they figure it out, you didn't tell them. They're going to go somebody else. A tangent. Okay, let me get back on track. The third factor is risk. If investors estimate the future potential net income from the property as less risky and more certain, right? That's kind of redundant. Less risky, more certain. Then they'd be willing to pay more per dollar of current income for the property. Again, reducing the cap rates. Other things being equal, investors don't like risk and will pay more for less risky assets. Investors' preferences for certain types of investments and aversion to risk may change over time. For example, some investors may want certain types of assets or properties in order to diversify or to balance their investment portfolios. So sometimes you might see an investor with multiple properties, and you're looking at one, and this one might be a money loser or something like that. And you're like, hey, why don't we do this and that? Well, that investor has a strategy for that property. Sometimes they just don't know. But they're putting different, it's not about it being a loser, actually. It's more about it might grow at a different rate. Its cash flow is different. You know what I mean? So they're just diversifying to really hedge against a loss. You don't want, I just own apartments in Southeast DC. You know, that's everything, all your eggs in one basket. The more investors prefer a type of asset that a given property is, the more they'll pay for it, and the lower will be their cap rate. Holding interest rates and growth expectations constant, these preference-based pricing differences may be assumed to be related to their perceived risk. I only buy chicken quick-serve restaurants. So investor might buy Church's, Popeyes, and I don't know, who else sells chicken? Chick-fil-A, right? Or I only buy hamburgers, Wendy's, McDonald's. You know what I mean? They invest like that because these type of properties have the same risk profile. I only buy apartments. Okay. Apartments in Georgetown has a different risk profile than an apartment in Arlington even, right? So, that's asset markets. Now you're more familiar, I hope, with space markets and asset markets and the role of capital markets and asset markets. So let's talk about another distinction between asset and space markets. While building users who make up the demand side of the space market require the physical characteristics of real estate, right? They're looking for a particular type of space in a particular location. That's not the case with investors who make up the demand side of the real estate market. Investors are looking for future cash flows, which are financial rather than physical assets. They don't really care how or from where the cash is generated. Cash generated from rents in Chicago warehouses is the same as cash generated from rent in DC area shopping centers, or cash generated from Amazon stock dividends, or a CVS bond coupon, right? It's the dollar amount is a dollar amount. It's the same. So therefore, real estate asset markets are much more integrated than real estate space markets, right? Which I described last week as segmented. And if you remember last week, the consequences of the lack of integration or the consequences of segmentation in the space market is that the price that prices in the form of rents can differ hugely between locations or among different types of properties. Even for the physically similar properties, prices can differ. In the same way, to a much greater degree of integration in asset markets, it has the opposite effects. Two properties with cash flows perceived as having similar risk and growth potential will sell at very similar cap rates, even if the properties are physically very different from each other and they're in different locations, right? And their space rents at very different rental prices. Another example to illustrate this point is found by, I jumped ahead. It's found by looking at these cap rates for a range of different types of properties and locations, and this is from 1994. That year, there were wide disparities in the level of risk perceived by investors in different space markets. But notice how, can you guys see those numbers? Notice how, At the bottom? I want to look real quick. Okay, malls, retail, here, let me just read it from here. So you have malls, the first column, other retail, office, central business district, CBD, office in the suburbs, office in Los Angeles, office in Manhattan, office in DC, office oversupply, warehouse, apartments, hotels, luxury hotels that is, and full service hotels, right? So they did property type and they did location differences. But notice how the cap rates for office, retail, warehouse, and apartments were very similar, around 9 to 10% per year. Cap rates. And this was true even across cities, as you see the different cities here, LA, DC, New York, where cap rates, well, because of the risk or growth prospect, were perceived as being different. And this is seen in cap rates reported for several types of location and properties. The oversupplied office market refers to office buildings in markets that were experiencing high vacancy. Investors perceived these markets to be more risky than the markets that were more imbalanced. Remember, this is in '94, so remember it was a huge oversupply, I think I mentioned that last week, at the end of the '80s. All this office space and high vacancies. So that's more risky. You have vacancy risk, right? Than the markets that were more imbalanced. So they required a higher expected return for investing in overbuilt markets. What do you do when you expect a higher expected return, right? You pay a lower price, right? You're not going to pay a higher price, right? Unless, what did I say? I lost track. Anyway. This is the same as being unwilling to pay as much per dollar of current income for these other properties. Notice that the 10.57 cap rate, right, indicates investors were not willing to pay more than $9.46 per dollar of current income for office buildings in overbuilt markets, compared to those in more typical central business districts and suburban office markets, where they would pay more than $10 per dollar of current income. Look at this. Hotel properties were perceived as being even more risky due to the lack of long-term leases from tenants and the volatility and high competitive nature of the hotel business back in '94. In '94, hotels were selling at cap rates higher than 11%, right? Compared to now. I think hotels are back around what, six and a half? I've seen 4s actually for hotels. At the other extreme, regional shopping malls were perceived in 1994 as being relatively low risk with relatively good growth prospects. That's over, right? Just a note. My, how things have changed. Malls had an average cap rate of only 7.73, like 7.75% in 1994, indicating property values of $12.94 per dollar of net income. Now this next slide shows how the prevailing cap rates tend to change over time. While apartments, that dotted blue line with the circles, had similar cap rates on average to the other major types of income property in the early 90s, by the beginning of the 2000s, apartments tended to sell at lower cap rates for higher prices per dollar of current income than other types of properties. And that's been a pretty steady trend, which suggests that investors began to perceive less risk or more growth prospects in apartments. So this slide highlights a huge decline in cap rates, right? All of those lines are going down across the board during the decade of the 2000s, reflecting a general decline in dollar-denominated real interest rates as globalization and evolution in our financial markets increased dollar liquidity. The bubble, you can see that on here, from 2004 to 2007, is shown as the decline in cap rates during that period. Falling cap rates imply rising asset prices, remember, and vice versa, as prices equal incomes divided by cap rates. The 2004 to 2007 decline in cap rates reflected the decline in risk premia, right? During the bubble, investors did not require as much extra expected return premium to invest in risky assets. Notice how the cap rates fell first and farthest in apartments, but then stopped falling in 2005, right? The other ones tend to stop in go to 2007. And this can be explained by the condo conversion boom that happened during that time, and then condo bust, which I mentioned last week. We're kind of going through a bust period now for office condos, FYI. All right, they're not selling. The boom in condos drove up the prices of apartments because investors could convert the apartments into condos. And then when the housing market weakened after 2007, that fell. From 2008 to 2009, cap rates rose across the board, but not so much for apartments, reflecting the associated collapse in property values. And this period saw a huge loss in liquidity in real estate markets. And investors began demanding sharply higher risk premia, right, associated with the financial crisis. Risk premium, meaning they need a higher return for taking that higher risk. The rise in cap rates also reflected reduced rental growth expectations due to the prolonged economic recession that grew out of the financial crisis. And the recovery in the market in 2010 is reflected by a drop in the cap rates. So, between last week and this week, just to summarize, that's it, see? I described the two major types of markets relevant to commercial property analysis: space markets, asset markets. The space markets determine the cash flows that properties can generate, and these cash flows underlie any value that the asset can have. So it's the more fundamental of the two. The asset market is as important because it determines the valuation of property assets. It causes and affects the flow of financial capitals to and from real estate. The asset market is most directly relevant to commercial property investment analysis. So far, in introducing these two markets, we've looked at the two most basic analytical tools, just two. One was cap rates, and one was that kinked space market supply curve, right? Over the next 2 to 5 classes, depending on how much we get covered per class, I'm going to bring together these two, space market, asset market, and link them to the commercial property development industry. That we're going to talk about that the next session, right? And then the three of these together, space market, asset market, and the real estate development industry, this is what's called the real estate system, right? I mentioned that last week and I realized, oh, I didn't explain that. Space market, asset market, and the development industry, that's the real estate system. So I'll use that term going forward. That's it for today. Any questions? About anything? We good? Let me share this one more thing. We're moving this office. You guys know that. We're moving. Folks online may not. We're moving from this building to another building. So I don't think there's any more of this class for January. I think our next one will be in February. Please check the calendar, right? Check the Cardinal Nest calendar for dates and times of the classes. When we get settled, I think we're going to go to an every other week, but don't quote me on that. Check the calendar. That's it, folks. Thank you. How'd I do? On time. Woo! Now I can yakety, yakety, yakety.